Here we are again, taking a look at some of the major financial questions you guys had when taking a look at what economic questions you wanted to learn. This week, we are taking a look at banking. So, let's jump into it. This week, we're looking at banks, banking institutions, kind of the history of it, and what is out there today as far as banks. So, over the last couple of weeks, just to review where we have talked about, we took a look at loans, which are our banking institutions and the government, which will loan people money in return for a contract signed by the borrower to pay money back over time plus interest. So when we were looking at this, we had our principal amount and our interest, which are the original amount you're borrowing, and then the additional amount that you are agreeing to pay on it. We led then into credit, talking about how do you get a credit score, what is that, what's your ability to do that. So basically taking a look at the ability to borrow in the future, and that's going to depend on how you have your spending habits and how well you pay your bills. And that will get you approved for other loans later on in life. So, taking a look at some of those banking institutions then today. All right, looking at the history of banking. So, the way you guys think of a bank today didn't really start happening in the United States until after the Revolutionary War in America. Previously to this, most banks were just merchants or other trade people who would agree to hold on to other people's money. So most of the time, a silversmith or a shoemaker, they would just hold on to people's money and agree to give it to them when they wanted, which created a lot of confusion in the United States. And in order to help this confusion, we have our two different party ideas during this time, and they had different thoughts on how the United States should set up their first bank or a national bank. So, on the Federalist side, you have Alexander Hamilton, who believed that a centralized bank was necessary for the United States in order to build and stabilize a young economy. On the other side, you have Thomas Jefferson with the Anti-Federalists, and he did not like having a centralized banking system. His belief was that states should establish their own banks and regulate within their own borders, that it was not a federal government issue to deal with banking and have that kind of oversight. Well, Hamilton ends up winning that debate and created the first Bank of the United States. This was created in 1791, and it was granted a charter for 21 years by the legislature of our federal government. The purpose of this was to hold money that the government collects in taxes, to help the government carry out the power to tax, borrow money, regulate interstate commerce, to issue banknotes, and to ensure state chartered banks had enough gold to exchange with their customers. Okay, so the first bank essentially helped the government organize and maintain a good economic system. Well, that charter obviously expired after 21 years, ends us up in 1812, and it caused the United States economy to enter into a period of financial confusion where people didn't really have that confidence in the worth of banknotes anymore. There were different banks issuing different currencies, so from state to state, they didn't have the same form of money, and that was really confusing. And some bankers were tempted to print more money than what they had to back up with gold or silver. So just a lot of different confusion. So Congress charters a second bank of the United States. Same premise, same system, just renewed that first charter. That didn't stick around long either. That expired in 1837, and again, our economy ends up going into some mass confusion. But we enter into our period with the Civil War quickly after. And this, with the Civil War, ends up causing confusion. We have different currencies between the North and the South, different agreements and taxes. It was just a hot mess. So, coming out of the Civil War, we have created the National Banking Acts, which essentially established national banking regulations and a standard currency. So we're seeing here more federal government intervention, stabilizing and making identical currency that can be used across different state lines. Yep, so established banking regulations and a standard currency. Obviously, later on down our history as the United States, we have our Great Depression, where banks were loaning out too much to too high of risk borrowers. We had crop failures, and people just weren't paying back on their bank loans. And it ended up resulting in nervous depositors to rush to their local bank and wanting to withdraw all the money. Banks didn't carry everyone's money at once, though, and so a lot of people lost a lot of money. As a result, coming out of this, FDR creates the Federal Deposit Insurance Corporation, and this was a way for the federal government to insure citizens that if you put money into the bank has to guarantee you so much money. So today you can be insured up to $100,000 that you're able to withdraw from a bank. So that was the banking of that time. What does banking look like in our system today? Well, one of the main purposes of banks today is to store money. So banks keep your cash in fireproof vaults and are insured against the loss of money in case there's a robbery. So essentially just giving it your money a higher amount of security. Banks also help you save money. So you can do this by setting up savings and checking accounts where it's useful for people who make a lot of withdrawals, and typically a bank will pay you for keeping money in your account. So annually you may get 0.2%, but for every dollar that you keep in there, you're going to get 0.2% back out. So that's one of the perks of having a savings and checkings account. We also have our money market accounts, where you're going to pay a higher rate of interest than your checkings and savings, but it's also going to help you save and to write a limited number of checks. So it's a way for you to help kind of save up that money again. We have our certificates of deposit accounts, where interest rates are going to be constant over however long you want, but typically you can't remove those funds until a certain number of years. So this is typically like retirement accounts is what you would set this up with. If you withdraw money early out of a certificate deposit, you're going to end up paying a penalty fee for that early withdrawal. And as we've talked previously, banks are providing services for loans, mortgages, and credit cards. If you have any questions about those, please go back and watch week 1 and week 2 for more information about loans and credit. Today, banks are accessible to all of their customers through automated teller machines, or ATMs, debit machines, debit cards, and online banking. And most companies now at this point also have cell phone apps that you can log into your account through. You can deposit checks by taking a picture of the check. So there's some really awesome options out there for people to get access to their money. So there's different types of banking as well when you're taking a look at banks and what systems they use. we have our commercial banks. And those are your Citibank, JP Morgan, PNC. These companies or these banks are providing services to businesses and the public, and they offer checking services, deposits, and they'll allow you to make loans through them as well. So your typical bank that you're thinking of most likely is your commercial style bank. Other financial institutions, we have savings and loan associations. So you can think of your First National Bank of Michigan. We don't have many here in Michigan. Your closest one is going to be here in Kalamazoo, where with this style of institution, you are lending money to an overall group to then help you buy later. So members deposit a fund into a large general fund and then borrow from that overall fund in order to help build into a home. So a lot of these today operate underneath commercial banks as well. So both commercial banks and savings and loan associations typically are working the same way these days. Next, you have your credit unions. So if you're thinking local, Marshall Community Credit Union, and this is a lending association for specific groups, usually employees of a specific business or a government agency will offer accounts to these groups. They're typically going to be smaller and they're specializing more in home mortgages and car loans. And they're going to typically have our better interest rates as well. Finally, we've got our finance companies. We have Independent Bank, Edward Jones. You see a lot of commercials for them on TV where they're making installment loans to customers. So they're going to be helping you with that loan period as well. People who borrow from finance loans are more likely to fail repayments, and so interest rates are more likely to be higher when you work with a finance company. So if you have any more questions about savings, investing, bonds, the stock market, and that aspect of the banking system, I would highly recommend you check out Chapter 11 in your textbook. They're going to have all of that kind of information for you. So that's all I got for this week. A little bit shorter of a video. Hope you guys are doing well. Hope you're staying safe and healthy, and we'll see you next week.